So we are going to now continue with today's seminar, which is estate tax and retirement account issues in this changing landscape. And Tony Hinson is an elder law and estate planning attorney with Sherrard McGonigal, Tizano and Lind. He's a principal of the firm, and he will be doing this amazing presentation for us. So Tony, the floor is yours, or should I say the screen?
The screen is mine. Well, thanks, Mary, and welcome, Amy and Eric. I will say, since we are recording this seminar, questions are always welcome, but please make them general. If you have particular personal questions about your personal situation, again, since we are recording this, and this will be available on Mary's website, ask that you really make your questions extremely broad and general that you have. So we'll go through and we'll start away. Disclaimer, basically this screen, please, utilize your full team of planning professionals. That would include your attorney, it would include your financial advisor, it would include your CPA, all working together. They know your finances, they know your particular situation, and they can take the general concepts we're going to talk about today and apply them to your particular position to put the best plan in place for you. So a little about me. I'm a Tennessean by birth, Washingtonian by choice, like a lot of us here. I went to Vanderbilt University undergraduate and University of North Carolina for law school. I served about 25 years in the Navy as a JAG between active duty and reserve, about eight and a half active and the rest in reserve. I retired last February, right before the world ended, so it was a good time to retire from the military. After my initial tour on active duty, I did about 9 years as an estate tax attorney with the IRS. So that's where I learned, I'd say the majority of my estate planning knowledge is just looking at returns and looking at what other estate planners had done, and really between the IRS education they provide and just the real world experience of looking at extremely well-constructed estate plans, learned quite a bit during those years. I now have come over to the good side of the force, and I work primarily focused on estate planning. I tend to focus on folks who have potentially taxable estates, so a little higher net worth, although I do bread and butter estate plans as well for the rest of us that don't quite have those estate tax problems. And I've got quite a bit of experience doing military wills as well. Next bullet point, just to see if you're looking or not. Live seminars, I can always look out and see if there are smiles there. So coming out of law school, I was convinced of two things. One, I was not going to marry a lawyer, and I was certainly never going to marry a Navy JAG, because that would be wrong, right? So I did exactly that. Married Kim, my wife. We've got 2 kids, 12 and 14, and I am a partner here with the Sherrard McGonigal firm and have been in private practice since around 2012. So today we're going to talk about 2 broad topics. One is estate planning with the particular emphasis on estate tax planning in an estate plan. And the other is going to be focused on individual retirement accounts and other qualified ERISA type plans, because they are interesting creatures when it comes to integrating into your overall estate plan. So what is a basic estate plan? I mean, we hear about this thing, we think will, trust, and all these other documents. When you boil it down, it really comes down to a set of basic documents with some add-ons if they're needed. First is a will or revocable trust. Now, if you listen to financial planning shows, read financial planning newsletters, or subscribe to financial planning gurus, they will always tell you you need a trust. You've got to have a revocable living trust because you want to avoid probate. In a lot of states, that is absolutely dead on correct. Primarily California, New York, Florida, other states where probate is a heavily court-driven process. The costs and the time and the administrative hassles are substantial in a probate, and you certainly want to avoid probate in those states. Here to give you the good news, here in Washington, we have a very straightforward probate system. Absent a controversy or an issue, the courts really don't get involved that much with the average estate administration. Even a large estate, a taxable estate, goes along with the executor or the personal representative or the trustee pretty much handling things on their own, unless, again, they hit a snag or they need instructions from the court. So we do probably 90% of our estate plans here in the office, and certainly on my end, are done using good old-fashioned wills. They don't require all the retitling that you need to do to make a revocable trust work, and they're just less less documents to produce and less expense on the front end as well. And they do everything we need, and especially in Washington with the straightforward probate system, there's really not a whole lot of difference between a probate and a trust administration. So that's the document that controls what happens when you die. Well, how about while you're still here, if you need people to help you manage your affairs? Those are the next two bullet points: the durable power of attorney for financial decisions and the durable power of attorney for healthcare decisions. You appoint what's known as an attorney in fact to make these decisions when you can't. The durable power of attorney for financial decisions will cover pretty much all of your financial management. It'll cover the power to make gifts. It'll cover the power to pursue lawsuits. It'll cover the power to control beneficiary designations on accounts, to create trusts, to manage business entities. Just about anything that you can do, your attorney in fact can do under that durable power of attorney. Two types of those. One is springing. It only becomes effective if you are incapacitated. The other is effective immediately. With the majority of my clients, I recommend that we draft these that are effective immediately. You're putting people in place that you know and that you trust. And so there's not really a reason from that perspective to put a firewall in there. And for ease of implementation with a springing durable power of attorney, we have to get a doctor's note, get them to write a letter that you're no longer competent to manage your affairs. And for a number of reasons, that's kind of a hassle to get and isn't necessarily the letter we want at that point. So an immediately effective financial power of attorney is more flexible in my experience. And it has the added benefit that if you just decide you want, say, your child to start helping you manage your financial affairs, they can be voluntold these things, and they can do so under the power of attorney. The durable power of attorney for healthcare decisions is always going to be springing, because you would always make your own healthcare decisions unless you can't. And in that case, your attorney, in fact, would step in to make those for you. The next is an advanced medical directive, directive to physicians, declaration to physicians. It goes by a lot of different names. It is at its core what we know as a living will. If you end up in a terminal condition or a permanent unconscious condition, this document lays out the parameters of the care you would like to receive, up to and including simply removing all artificial means of support and allowing your body to do what it naturally is going to do, either continue on living or to die a natural death. And your healthcare attorney, in fact, is the person that would make that possible. Finally, additional documents, we'd add these on as we need them. Insurance trusts, if we want to have life insurance outside of the taxable estate, we would use what's known as an ILIT, irrevocable life insurance trust. Retirement plan trusts can hold IRAs. We'll talk about those in some detail here coming up in the second part of the presentation today. You can leave a sheet with detailed funeral desires. It's a great idea to do that. It really assists your beneficiaries, particularly your kids, in knowing exactly what your wishes were with respect to your desires when you pass. And it just provides a lot of comfort to them that they would know that they're doing what you wanted. And then finally, a community property agreement. In taxable estates, I don't use these that often, and I never use them for testamentary means. Community property agreement, essentially a document where you can decide what assets between a married couple are separate, what are community, what the effect of new assets acquired in the future would be. And then a lot of these have got a provision in there that upon the death of the first spouse, everything flips over to the survivor. It's another probate avoidance tool. Again, we don't really need that in Washington so much. I do use those from time to time just to clarify community property and separate property between spouses. Planning for minors. So you've got either children, you've got grandchildren, nieces and nephews, or just kids that you want to provide for in your will. Well, as we know, they can't hold substantial assets in their own name as a minor. So we'll almost always use a descendants trust or some other type of trust to hold the assets that you've left them for a term that you decide and under the terms that you decide. So basic structure is common expenses are always allowed, education, support, if they want enrichment events, if they want to take sports, if they want to take music, if they want to go to private school, if they need transportation for schooling. All of these are legitimate expenses of these trusts, and the trustee can expend these funds for the minor's support in those areas. You decide when the trust pays out to the minor, then an adult, and at what age. We start at 25 is a good age to start considering. We can go a bit younger, we can go a bit older. You can stagger it. It can be halves and halves, or thirds and thirds, or quarters, or really whatever kind of distribution you decide is best with your knowledge of that minor at heart. Doesn't have to be the guardian. It can be someone entirely disconnected from the guardian. So if they're your child, you can name the guardians in your will, and the court will give great deference to that nomination. If they're not your kids, then you have really no control over who the guardians would be, but you can set the trustee, and it does not have to be the guardian of the person. And finally, we can put incentives and disincentives in these trusts. We can provide for graduation from a 4-year institution or a 2-year institution with an associate's or bachelor's, or trade school if the child's going to be going into the trades, and provide maybe a principal distribution at that point to encourage that kind of higher education and training. And we can put in disincentives. If this person has had, for example, a history of challenges when it comes to substance abuse, we can require urinalysis before distributions are made. So these can be as flexible as they need to be to cover the individual situation. So let's move on into the estate tax planning world here. Just cover some basic concepts. Here in Washington, we have 2 regimes we've got to be concerned with: the feds and the Department of Revenue here in our good old state of Washington. The feds site right now, things are like this. We have a 40% rate on assets held at death and lifetime gifts. If those two total over $11.7 million per person, then we have a federal estate tax that's applicable. Right now, Congress is debating the infrastructure bill, the America Cares Act, and a lot of other possible provisions which could substantially change the entire structure of the federal estate tax. So stay tuned, keep your ear on the news, and we'll find out, all of us will find out a little bit later this year, what, if anything, Congress is going to do. One substantial change they might make is to remove or reduce what we call the step up in basis at death. What that means is that if you purchase an asset for a certain amount of money, and that asset increases in value, and you sell it, then as an individual, you'd pay capital gain on that. Capital gains taxes are typically much lower than ordinary income, like salaries and wages, but you still pay tax on the gain of that asset between what you paid for it and then what you sell it for. Currently, if you die and leave an asset to a beneficiary, they get a basis equal to that date of death value. So if then they turn around and sell it, they would not pay capital gain on the whole amount of the gain since you bought it. They would only pay capital gain on any amount that had increased in value since you died. So that capital gain between the time that you buy it and you give it away at death is never taxed currently. And Congress is debating whether or not that should be taxed at death. There would be $1 million exemption on gains, and then gains in excess of that would be taxed potentially at the highest marginal rate. So it could be as high as 43% in some things I've seen. So stand by. Currently, the exemption is increased yearly, goes up per the Consumer Price Index. And your taxable estate, remember this, it includes a lot of stuff you might not think about. It includes the death benefits on life insurance, unless it's held in a special type of trust. Your 401ks, your IRAs, lots of things that don't pass via probate will be part of your taxable estate. So it's basically anything you control, any kind of financial asset that you control, what happens to it and where it goes. It also covers lifetime gifts in excess of the annual exclusion amount, which is currently $15,000 per year per person. Now, people think that's a gifting limit. It's not. You can give away anything you want to give away. It's just that amounts over $15,000 count toward that $11.7 million credit. So that's the Fed laydown. The Washington estate tax is a progressive rate, goes from 10% to 20%, and the credit there is $2.193 million. And that's been frozen in place for a couple of years due to some quirks of the federal law that I won't go into here. There's no gift tax in Washington. So you can give away $100 gazillion dollars. As long as that gift is complete at your death, there will be no Washington estate tax on it. Now, if you look above, you can see that there's certainly going to be federal estate tax on it because that gift is going to count towards that credit. But in Washington, it's just what you die with. in large part. There's some provisions for a 3-year look back, like a gift of a life insurance policy, for example, but by and large, it's what you have at the moment that you pass. Same definition of the estate as for the federal purposes, and the exemption is likely fixed until 2025 under current law. Then again, Congress, as I said, is tinkering this year, so we'll find out later. Could be going up. So simple estate tax planning, basically what we're doing on both the Washington and federal side is trying to take advantage of the credits. That's kind of our first step, is to make sure that we fully utilize those credits. So when do we start worrying about estate taxes? When do we start considering those in the plan? Well, for the federal purposes, I really, for a married couple, I think about $2 to $4 million. Right now, well below the limit. Well below the limit. It's $23.4 million for a married couple. But if that provision sunsets, then that will come down to $6 million a person. And if Biden's administration puts into place what they had spoke of during the election, it could be as low as $3.5 million per person. So those huge numbers could come down. Still very big credits, but not nearly as big as they are right now. So age, health, investment, asset mix, all that comes into play. You know, estate planning for a 90-year-old with $2 million is a lot different than estate planning for a 50-year-old with $2 million, just due to growth and the time aspect, and the fact that the 50-year-old is likely still earning either a wage or a salary, and so their investments will continue to increase in value. Washington, basically at the $1 million point, either for a married couple or an individual, we need to start talking about having a basic estate plan in place. It's a very low threshold, as you can see. You know, you put a house on there and a life insurance policy, and you're probably over that amount here in Kitsap County. For Washington, there's no gift tax, as I mentioned. So if we're over the $1 million, but well below the federal concern, maybe we talk about doing some gifting when it makes sense. You certainly don't want to gift yourself too far so that you no longer have an asset pool for income. But if we're over the limit, but we have a lot of federal credit to play with, then gifting can certainly come into play there. Let's talk about what happens with a lot of clients who come in the door here. They've got an estate plan in place, put into place long ago, and it is what we call an I love you will. That basically is everything to the surviving spouse, and then upon the surviving spouse's passing, then to kids in equal shares, with grandkids taking the share of a parent that deceased them. That's known as per stirpes. It's a very common estate plan. It's very functional. It's very traditional. And if you don't have estate tax issues, it's a very effective estate plan. However, with a $3 million estate, let's kind of run that to ground and see what that looks like. We'll talk about it in depth in the next slide. But as a result of the fact that the decedent's community half of that $3 million estate, or $1.5 million, all passes to the surviving spouse, when that surviving spouse passes, the Washington estate tax on that would be about $81,000, because we would only use the credit of the surviving spouse. We would have foregone the credit of the first spouse to die, and so we would end up with estate tax in this case that we really don't have to pay with just a basic amount of planning. So what are the dangers? Again, everything, our example, $3 million, all community property. On the first death, no problem. There is a 100% deduction for anything passing to a surviving spouse. You can leave, as I said, $100 gazillion to a surviving spouse, no estate tax. If Bill and Melinda Gates were still married and had an I love you will in place, no estate tax upon the first to die. The problem is you haven't used the credit of the first spouse to die, particularly on the Washington side. So you've foregone that credit, and on the Washington side, it just goes away. On the federal side, we can actually file what's known as a portability election and take that credit with the surviving spouse and use it either for lifetime gifting or when that spouse dies. So an I love you will, from a federal perspective, if you're on the ball and make this portability filing, is not a catastrophe. However, let's follow this down to ground here. So on the second death, because we didn't use the credit, that portability election might save us, because we could use the deceased spouse's credit at that point, add it to the surviving spouse's credit, and use both credits. On the Washington side, use it or lose it. It's gone once you don't use it on the first spouse to die. So the second spouse's credit is $2.193 million, and we'd end up, as I said, with over $80,000 in federal and Washington tax. Potential federal if we didn't make the portability election, and the credit amounts came down as well. So the fix to that is something called a credit shelter trust. This is designed to take that first spouse's half off the table for estate tax purposes by running it through the estate tax mill when the first spouse passes. So instead of everything passing directly to the surviving spouse, we instead send it down to a credit shelter trust. Terms of the trust are very liberal. The surviving spouse, is often the trustee. They can take income distributions. All income annually can flow to them, so the dividends, interest, all of that from those investments can come into the surviving spouse. If that trust owns a house, which is the residence, then that income interest means they get to live in the house. They get to continue to live there without having to pay a mortgage or rent or anything. So a very powerful plan to have in place. In addition, the surviving spouse can draw upon the principal of that trust for their health, education, maintenance, or support. It's an IRS-approved ascertainable standard, which means that they don't have unfettered access to the money. They can't go to Vegas and bet it all on red, for example. But the health aspect is pretty straightforward. It can draw upon the principal for health care, for supplemental health care, for elective health care procedures, and for assisted living or other community-based care as the surviving spouse ages. The education, again, pretty straightforward. You want to go back to school, not a problem at all. And I see there's a question. I'll pause right at the end of this slide and see what that is. And then the maintenance and support, probably the more functional portions of this, basically means that the surviving spouse maintains the lifestyle they had when the first spouse passed. So if you normally drove a Honda Accord, you can buy a new Honda Accord out of the trust. If you typically drove a Mercedes, you can buy a new Mercedes out of the trust. So it's just keeping that surviving spouse in the lifestyle that he or she enjoyed with their spouse when that spouse passed on. As a result of it going to the credit shelter trust, we don't use the marital deduction on it. Instead, we use the spouse's $2.193 million Washington credit on it. In our example, $1.5 million goes to the trust. We've got a $2.193 million credit, no estate tax. And the credit shelter trust is not in the estate of the surviving spouse when they die, so they just have their own $1.5 million. They've got their own Washington credit. So that $81,000 of estate tax that was payable with the I Love You will is not payable under this fairly simple plan. From the surviving spouse's perspective, the credit shelter trust should be virtually transparent. Again, you can't go to Vegas and bet it on red. You can't just blow it. You can do whatever you want to with your money, but the credit shelter trust is there for your maintenance and support and healthcare needs. And I'll stop here.
We have a question, Tony.
Absolutely. Let me pull it up here.
Is the shelter trust capped at 50% of total estate or the Washington 2.2 million exclusion?
Great question. So the answer to that is when the first spouse dies, their estate consists of what they own. So if it's a $3 million community property estate, then it's $1.5 million. You can't take community property from the surviving spouse and put it in there too. And you don't want to, because otherwise that would be a gift. And gifted property into a trust opens up all kinds of cans of worms. So we don't want to do that. But so it is capped at half of what the couple owned in community property, plus any separate property that the deceased spouse had. Did that answer the question?
Did that answer your question?
Actually, it's Frank.
Yes, Frank. Hey, so just to be clear, so say an estate value is $5 million, right? It's just use that as a number. So can 2.5 go into the credit shelter, or is it capped at the 2.2 Washington exclusion that could go into the credit shelter?
In that example, we would put the full 2.2 million into the credit shelter trust, and the overage could go one of two places. It could go directly to the surviving spouse, or it could go into a marital trust, which is virtually the same structure. We just make an election on the estate tax return, which would treat that trust as a marital trust, would get the marital deduction applied to it and would be includable in the estate of the second spouse to pass. And I believe that's covered in my next slide, but a great follow-on. So you can put up to the maximum amount which can pass free of both Washington and federal into the credit shelter, and then we would put the excess into a marital type trust for the marital deduction on the Washington side.
Okay, thanks.
So, and that kind of takes us, I'll talk about some common estate tax deductions, and then we'll talk about those flexible type trusts on the next slide. So deductions, first, debts of the decedent. I get asked from time to time, okay, our house is worth $1 million, but we have a $600,000 mortgage on it. So you're telling me that I'm going to be taxed on the full $1 million? And the answer is no. Debts of the decedent are a deduction from the estate. So if it's a married couple, first to die, the home is included at half the value because the community property interest. And if there's a mortgage, then half the mortgage is included. That's the community share of the mortgage on the home. Expenses of estate administration are deductible as well. If the estate itself is non-taxable, often those are more useful on the estate income tax return, and you only get to take them on one return. And so that's part of the team concept, is that the attorney preparing the estate tax return and handling the probate needs to be in touch with the CPA who's handling the fiduciary income tax return, just to make sure that those deductions are being taken in the maximum effective way possible. The next two are the biggies. The marital deduction, again, 100% of assets passing to a spouse outright, eligible for the deduction. And then if we use a marital trust, you can still control, as the decedent, where the money goes at the end of your surviving spouse's life. But if it has those basic elements in it that I told you about the credit shelter trust, all income to the surviving spouse, no one else is a beneficiary, the surviving spouse can force the trustee to put the assets into productive assets, and you make an election on the estate tax return, then it's known as a qualified terminable interest property trust. And yes, it's known as a Q-tip. When this was first instituted by the IRS, Johnson & Johnson pushed back on that, but they soon realized it's free advertising. And so it's been in place ever since. And I draft all of my credit shelter trusts, by and large, to be Q-tip eligible trusts, or Q-tippable, if that's a word. It's a very flexible, you have to make the election on the return, and the Washington and federal elections can differ. And in the era of the basis, step up in basis, I've worked with clients many times where we make a Washington election to treat a trust as a credit shelter trust, but make a federal election to treat it as a Q-tip trust, so that it's in the estate of the surviving spouse. We make a portability election so that we keep both credits, and then the heirs get a basis step up when that second spouse passes as well. If Congress changes the law dramatically on us here, that strategy will not be as effective anymore, but it's been an effective one for many years. And then finally, what passes to charity as directed by the will or the trust is a deduction from the estate as well. It needs to be a qualified charity. It can be a family foundation, but that runs into some very complex planning. By and large, any recognized charity, you'll get a deduction off of the estate value for tax purposes. So an alternate I use is something called a one-lung trust. And this is drafted exactly the way I told you about before. All income to the surviving spouse. Surviving spouse can dip into the principal for health, education, maintenance, and support. So but if you make an election on the return, it's a Q-tip trust. If you don't make the election on the return, it's a credit shelter trust. And so we can make different elections for Washington and federal purposes, both for estate tax planning and potentially for some income tax planning. It's just a very flexible way to go. And all of these trusts can be funded really in two basic ways. One is a certain pecuniary or a fractional that's defined in the will or the trust, and will absolutely go into those trusts when the first spouse passes. The other method I use on a potentially taxable estate, we're not sure exactly where we're going to be in the future, is something called a disclaimer funding mechanism, where everything per the terms of the will or trust goes to the surviving spouse. So it looks like an I love you will, but there's an option to disclaim assets into the family trust or the credit shelter trust within 9 months of the date of death of the decedent. There are some restrictions. You can't utilize the property in a substantial way. You can live in both halves of the house, for example, but you can't take possession of an asset. For example, you couldn't retitle the house in your own name and then disclaim it. So there's some care that must be given during the probate, but it's an extremely flexible approach. So if when the first spouse passes, the estate is substantially smaller than we thought it might be, maybe the surviving spouse chooses not to disclaim. The other option is perhaps the surviving spouse kind of runs the numbers and realizes that their heirs will be responsible for X in taxes, a good planning number, and they're okay with that. They don't want to deal with a trust. They just want it outright, and they know that it's going to result in estate taxes, but they are willing to take that risk for the simplicity of not having the trust in place. They might not disclaim in that case either. So estate tax takeaways before we move on to the IRA section of this. Simple planning can allow a married couple to basically use both credits. Over $22 million, or actually over $23 million now tax-free to heirs, and $4.4 million Washington estate tax-free. That federal credit's likely to come down either this year, next year, or certainly in 2026. It's going to come down from these high levels, but it's still going to be higher than the Washington estate tax credit. There is a possible fix for failing to plan for federal purposes. We can make that portability election, and at least the surviving spouse can use both credits. No such fix for Washington. It's a use it or lose it kind of state. So that's why you want to review your assets, how they're held, and your overall estate plan with your planning professionals, and incorporate the marital deduction and the credit shelter deduction, and as well as potentially charitable deduction as well in your planning. So before we move to IRAs, I'll stop here and see if there are any questions from Amy or Eric.
There are none on the chat bar, but if anybody wants to ask and unmute, feel free.
All right, we'll dive into the light and airy topic known as IRAs in estate planning. So there are some quirks here. We'll talk about how IRAs are very different from other types of estate assets, how their planning needs to be specialized, and things you should know as we move forward. So how do we get to the fact that IRAs are such an important part of estate plans? Well, they become a significant portion of estate planning price for more and more clients as they've grown in value. When I first started working with the IRS way back in 1999, you know, I'd have a $5, $6, $7 million estate with a $50,000 IRA in it. It wasn't a large portion of the estate. We had those $2,000 contribution limits in place for many, many years. 401ks had not yet really begun to gain huge values, and so we didn't see the rollovers yet there either. We're really, from the 1980s on, we're seeing a rise in these 401ks and these IRAs because we are trying an experiment, in my opinion. We're moving from a defined benefit pension type of retirement structure to a defined contribution, the 401k and the IRA approach to retirement planning. Will it work? We're going to find out, because that first generation that really relied upon the defined contribution approach is now approaching and just barely into retirement stages. So we'll see how well this all works. What we do know is that retirement accounts have grown tremendously just in the past few years. In 2015, there were $24.7 trillion in retirement plans, and that had doubled since 2000, and had gone up a third since 2008. So as you can see, this is something that's gaining momentum as people are entering, that generation is both entering their prime earning years and beginning to retire. Those types of assets have grown hugely in our economy. IRAs account for $7.6 trillion of that, and that had doubled between 2007 and 2015. So as you can see, these accounts are just exploding. And what was once an afterthought of estate planning has become, in some cases, the dominant asset in an estate plan, is that large IRA that's often a function of a 401k rollover. Most important thing to know about IRAs are the next 2 bullet points. If you take nothing else from this seminar on IRAs, these 2 points. IRAs do not pass under your will or trust. Whatever you have in your will and trust does not matter to your IRA. Your IRA passes by its own beneficiary designation, and it absolutely controls where that IRA goes. If it says to your estate, Then the will may affect the IRA, but only if the beneficiary designation sends that IRA to the estate in the first place. Not subject to estate creditors when it passes directly to beneficiaries. Could be subject to the beneficiary's creditors upon receipt, but if the decedent had some creditors hanging out there, then the IRAs and life insurance, for that matter, passes free of those claims if it passes directly to a beneficiary. If it goes through the probate estate, then it's subject to probate claims. So you want to make sure that you review your IRA beneficiary designations, your 401k beneficiary designations, your life insurance beneficiary designations to make sure that they are up to date. Another little known point, if a divorce occurs, then for joint tenancy accounts, pay on death accounts, the majority of things you can hold jointly with a spouse, those get, the jointness of those get wiped away by the dissolution, and there's no longer the survivorship. That does not apply to IRAs by and large. So even a divorced person needs to carefully make sure that they've taken that former spouse off of that IRA beneficiary designation. That can present huge trouble, and it has just in probates that we've handled here in the office in the past. Designating beneficiaries. Okay, now you're listening and you're like, all right, Tony, I want to designate. What kind of beneficiaries work? By and large, people, actual, honest to goodness human beings. So spouse is the typical approach, but child can be a beneficiary as well, certainly. Grandkids, parents, brothers, sisters, friends, enemies, neighbors, doesn't matter. People. People take IRAs subject to the most advantageous schedules when it comes to having to withdraw from the IRA once they inherit it. So the permissible part of it means that we treat those people, we treat those beneficiaries as under the most advantageous time schedules for pulling RMDs, required minimum distributions, out of the IRA. And I put on there certain trusts carefully drafted to accommodate IRAs. We'll talk about two of the major types of those a little bit later on. Who are non-permissible designated beneficiaries? And does it mean you can't leave it to them? No. It just means that they don't take advantage of the advantageous RMD schedules. So estates, IRAs payable to an estate. It happens, and unfortunately what that leads to is either you take the decedent's RMD or the least advantageous beneficiary's RMD. It really limits what you can do in terms of slowing down withdrawals from the IRA. Charities, however, as we'll talk about, charities are awesome beneficiaries of traditional IRAs. And then finally, most trusts. Works just like an estate. If you leave your IRA to a typical revocable living trust, then the beneficiaries of that trust do not get to take advantage of their own individual RMD schedule. They're going to be locked into some other schedule based upon the IRA passing to that trust. So we'll talk about the old rules first and then what's in place now. So the old rules, let's see, we have a chat. Okay. No. So if you leave your that's a great question. Does the IRA trust beneficiary use precede the Washington State exclusion implementation? I think I know what you're asking there. So I'll answer it this way. We'll talk about leaving an IRA to a spouse in a trust in an effort to use some of the Washington credit. And if an IRA passes directly to a non-spouse beneficiary, then it's going to use a portion of the credit on its own passing. And so that trust funding would be reduced accordingly, because you get this IRA passing outside of the probate estate directly to the beneficiary. So before January 1st of last year, IRAs passing to a spouse could be rolled over to a spousal IRA. And the new spouse is the new owner for required minimum distribution purposes. So they could take it 59.5, had to take it 70.5. Otherwise, it's as if that first IRA owner never existed. The IRA simply becomes the spouse's IRA. IRAs passing to a non-spouse is always going to be an inherited IRA from that point forward. And the required minimum distributions had to begin the year after the decedent died, regardless of the age of the beneficiary, but you got to use the beneficiary's life expectancy to draw the IRA down. So that was known as a stretch IRA, because particularly with a young beneficiary, they would have 40, 45 years left on the IRS mortality tables, so they could take 1/45th and then 1/44th and then 1/43rd, very small chunks, at least in the first few decades and allow that IRA to grow tax-free inside the IRA itself. If the IRA does not pass to a designated beneficiary, then there's no beneficiary in place, then you're stuck with two possible distributions. If the decedent was younger than 70 and a half, then you've got a 5-year payout that applies. If they were older than 70 and a half, then you take their RMD schedule. And because estate planners have kind of a dark sense of humor, that's known as a ghost RMD. So if the decedent was 83 years old and failed to leave it outright to a 40-year-old, and instead the 40-year-old got it through the estate, they'd be locked into that decedent's RMD schedule of about 15 years. I'm sorry, no, it'd be about 12 years at that point. So as you can see, it would accelerate it greatly. Same rules for Roths, except that if it goes to a non-permissible designated beneficiary, we always assume that the owner died before 59 and a half, and therefore it's a 5-year payout if we don't have a good beneficiary designation in place. The differences between a Roth and a traditional is that when the beneficiary draws the money out of a Roth, it's not income to them either, just like it would be income to the original holder. Then the Secure Act came about and really changed everything when it comes to IRA planning. Life After, it's called the Setting Every Community Up for Retirement Enhancement Act. And when Congress uses the word enhancement, somebody's going to take it on the chin. And in this case, it was it was IRA beneficiaries really got disadvantaged because of this. What they did was they expanded access to 401ks for smaller companies. So that was a good thing. That was going to result in a loss of income tax revenue as people moved money off the table pre-tax. And so to make that up, they basically eliminated the stretch, as we'll talk about. The other good thing that happened is the RMD age went from 70 and a half to 72, being the age that you have to take RMDs from an IRA. If you weren't yet 70 and a half on January 1st of last year, then you got an extra 18 months before you have to start drawing from your own IRA. And it now allows traditional IRA contributions after age 70 and a half. Has to be earned income, has to be wages or salaries, but if you continue to work after 70 and a half, you can continue to contribute to an IRA. Other good news, spousal rules still in effect. So the spousal rollover still allowed. Everything works exactly the same as it did before in that case. From the estate planning perspective, we lost the stretch. So instead of being able to use the life expectancy of a non-spouse beneficiary to slow down those IRA distributions, we're now locked into a 10-year payout after the decedent dies. So there are limited exceptions. Some types of beneficiaries can use their life expectancy. We'll talk about in about 10 seconds here. But by and large, beneficiaries will have to draw the IRA down within 10 years. And in almost every case, that's going to result in an acceleration of how fast the assets have to leave the IRA, which results in two things. Income being realized earlier, because you're going to liquidate the IRA a lot faster, and you lose all of those years of tax-free growth inside the IRA, because once the IRA pays out, even if you leave it invested, it's now going to be in a taxable account, so each year you're going to owe income tax on the dividends and interest, whereas in an IRA, those just accumulate tax-free until you pull them out. There are exceptions to the 10-year rule, and we got a new acronym out of this, which warms my Navy heart. It's called an eligible designated beneficiary. Surviving spouses can elect to use their life expectancy as opposed to doing a rollover. We'll talk about why that makes sense here in a second. Individuals less than 10 years younger than the IRA owner, I think the public policy there was it's not going to really slow it down that much, so we'll let them use their life expectancy. The next two are very important: chronically ill heirs and disabled heirs. What this does is it allows us to put IRAs into special needs trusts and still use the life expectancy of the beneficiary to slow the withdrawals down. Those trusts will tend to be accumulation trusts, and so if we can slow down withdrawals into the trust, that's a good thing. We'll talk about that in a second. And then finally, minor children of the owner. So it's not any minor, but if a parent leaves an IRA to a child who's a minor, they can use their life expectancy until they hit 18, and then it's a 10-year payout after that. So basically until they hit 28. Any beneficiary who receives an IRA from an eligible designated beneficiary doesn't get to use that, that schedule, they're stuck with their own 10-year payout. So when is this important? Well, first of all, we'll talk about Roth IRAs. Those questions pop up. For estate planning purposes, Roths act almost exactly like traditional IRAs. The key difference is they aren't income to the beneficiary. So the beneficiary gets a dollar for dollar benefit from the inheritance they receive. But otherwise, they behave almost exactly. We did talk about the fact if you don't have an eligible designated beneficiary on a Roth, then you might be stuck with that 5-year payout, which is not advantageous. Doesn't allow stuff, again, to grow inside the Roth tax-free. Doing a Roth conversion is an excellent tool for a couple in retirement for 2 reasons. One, you can go on and pay the income taxes when you're at a relatively lower rate during retirement, as opposed to your kids paying the income taxes when they're in their prime earning years when they inherit the IRA. The other possible, if you've got Medicaid planning down the road and we need to move assets between spouses, unfortunately, if a spouse is going to go into long-term care that Medicaid would pay for, we would have to liquidate their IRA. If it's already been converted to a Roth, at least you don't have the income tax hit when you do that. So doing a slow roll Roth conversion can make a lot of sense in a lot of circumstances. Definitely work with your financial advisor and your CPA to make sure you do it in the most income tax efficient manner possible. So I've told you trusts are generally bad for IRAs, which is true. But if we specifically draft a trust to receive an IRA, they can be very important planning tools. So typically, if we leave an IRA to a standard revocable trust, then the decedent's RMD or the 5-year rule applies. Now, if after the Secure Act, if we're stuck with a 10-year payout for most beneficiaries, there could be a circumstance where you might actually intentionally violate this rule so that you'd be stuck with the ghost RMD. So let's say that the decedent was in their mid-70s. They've got a substantially longer than 10-year payout per the tables. And so maybe we do leave it to the estate, or the child who would inherit it disclaims, again, that word, and so the IRA passes as if that child predeceased the owner, and it would go to the estate and then boomerang right back to the kid, and they would now have a longer payout structure from that. However, specifically structured trusts and drafted trusts do allow us to look through the trust itself to the beneficiaries and use the beneficiaries' distribution timetable for RMDs. Very useful for using the credit shelter amount in terms of spouses, or for spendthrift or special needs trusts for other beneficiaries. Spendthrift is a nice legal term for someone who doesn't manage money well and you don't want to leave the money outright. A spendthrift trust provides some protection for them from their creditors and some protection from themselves from spending the money too quickly. Use is very limited after the Secure Act, however. So conduit trusts, there's two types of trusts we use in IRA planning, conduit and accumulation. The first is a conduit trust. It's exactly what it sounds like. As RMDs leave the IRA and hit the trust, they're passed out directly to the beneficiaries. The trust is a conduit for the RMDs. It's very flexible. Beneficiary can be the trustee, and we would use this in large part for marital conduit trusts. Let's say the IRA is a huge asset and we don't have enough outside of the IRA to take full advantage of the Washington credit shelter amount, for example. We might take a portion of that IRA, put it into a marital conduit trust, not make the marital election on it, and so basically it flows to a credit shelter trust. When the surviving spouse dies, it goes to beneficiaries and it's not part of his or her estate. And again, remember the spouse is one of the exceptions to the 10-year payout, so they can actually use their life expectancy to draw the IRA down while they're the beneficiary of the trust. Now, when they pass it to the beneficiaries after they die, they would have a 10-year payout, but you would save estate taxes because the IRA would not be owned outright by the surviving spouse. We're almost positive this still works. The IRS, and Congress need to give us a little bit more guidance. The Secure Act was a little bit clumsily drafted in certain areas, but we're pretty sure this still will work. You've got to really balance, if you use one of these, the state tax savings versus the family considerations and other considerations as well. Do you want to tie the IRA up inside a trust, or is it almost worth it sometimes just to pay the additional Washington estate tax and leave the surviving spouse as the absolute owner of the IRA? But this is a useful tool in some circumstances. The other type of IRA trust is an accumulation trust, and it's what it sounds like. As RMDs leave the IRA and hit the trust, they can either be paid out by the trustee or accumulated within the trust. Now, the accumulation within the trust can present an income tax problem because trusts pay the highest marginal rate at about $12,950 of income in 2020, and I need to update that figure for 2021, but it's a fairly low amount, and they're already at the highest marginal rate. Whereas if you pass the income out to beneficiaries, they pick it up on their own 1040, and they pay what in many cases is a substantially lower marginal tax rate. However, the biggest use for these post-secure would be for supplemental needs trusts for folks who are qualified or want to qualify for Social Security or Medicaid to assist their care. If they meet the definition of chronically ill or disabled, the IRS definition is a little different than Social Security's definition, which is used for Social Security and Medicaid. My assumption is this is not going to be a huge audit area for the IRS. There's just no public policy behind it. So I would think that if you, in a good faith basis, meet this definition, likely the IRS would respect it. What it means is that the IRA can be payable to that supplemental needs trust, and the beneficiary, it's not counted against them for qualification for Social Security, disability, or for Medicaid, but yet the IRA within that trust, the proceeds can be used for their supplemental needs to augment what Social Security or Medicaid will fund on their own, make their life a little better. And also, if you have a significant spendthrift issue, we can use it in those cases as well to hold the IRA away from the beneficiary that you're scared would simply liquidate it. The cost of that is, that they don't get the stretch provision. They would have a 10-year payout. And if you don't pay the IRA out to the beneficiary as it's received into the trust, you're going to pay the high income tax. But in some cases, it's worth it because you're providing some security for that beneficiary that otherwise wouldn't be that responsible with the money. IRAs and charities. So remember I said that charities make excellent beneficiaries for traditional IRAs. And this is because when a traditional IRA pays to a non-charitable beneficiary, there's an income tax event. You got to pay income tax on that money. When a traditional IRA pays to a charity, charities don't pay income tax. So they get a dollar for dollar benefit from that IRA as opposed to a non-charitable beneficiary. So if you've got an estate where you're thinking maybe 2/3 to the kids, 1/3 to charity, and let's say an IRA is roughly 1/3 of the value of your estate, one way to do that would be to make the IRA 1/3 payable to the charity, 2/3 payable to the kids, and then your will would have a 1/3 payable to the charity, 2/3 payable to the kids. Maybe not the most tax efficient way to do that. How about instead we make the IRA completely payable to the charity, and we don't put the charity at all in the will. So the kids receive the house and the other assets, which won't be income as they receive them, and the charity gets the IRA, and they get the full value of that IRA, whereas the kids would have to pay income tax on it. So just it's an example of thinking outside the box a little bit for the maximum estate tax savings and the maximum income tax savings down the road. IRAs and durable powers of attorney. Traditional older durable powers of attorney often do not have express IRA authority in them. And we're finding that's more and more of an issue with IRA custodians. So the newer durable powers of attorney, and certainly the ones we draft here, all have clearly enumerated powers when it comes to IRAs, 401ks, and other qualified plans to make sure that you can move funds between plans, you can designate beneficiaries if you need to, that your attorney, in fact, has all of that authority to do that, so that you don't end up with a situation where you've got an IRA and no power to do anything with it, because, again, IRAs don't pass per the will, and it's great to have beneficiaries in place. War stories, I was working with an attorney on the other side of the water who had a client who, it was a spousal couple, both had lost capacity, and a child had stepped in as the attorney, in fact, for both parents. Parent one passed, and the IRA went to parent two, exactly the way that they'd always envisioned. And so the child rolled that over into a spousal IRA for their parent, exactly what they should be doing. So everyone was doing exactly what they ought to do. The problem was the power of attorney that the child was operating on did not give express IRA authority. The IRA custodian allowed the rollover because that was basically what the beneficiary designation was. But they would not let the child set beneficiaries on that new IRA. And they were going to set it to themselves and their siblings in equal shares, exactly the way the parents wanted. But they couldn't do it under the power of attorney because the power of attorney was a bit older and not drafted with IRAs in mind. We were able to get a court order to allow it in that case, but that's expensive, it takes time, and some judges might not sign that order. So definitely have those powers enumerated in your power of attorney to allow your attorney, in fact, the maximum flexibility. So next steps, I'm going to be signing off after answering any questions that have popped up, and offer you the opportunity to come in for a consultation. We'll take a look at your entire estate plan. Particularly, we'll take a look at your IRAs and other plans if you have those in hand. Make sure it works together. In a lot of cases, if you've got a well-crafted estate plan, we might need to tweak it a little bit, or it might be good to go as it is, and the peace of mind of that can be invaluable. In a lot of cases, however, we need to rework the estate plan a little bit. We might still have it, your children going to live with Aunt Maud, and your children are now 42 years old. The good news is, I can tell the kids they don't have to go live with Aunt Maud anymore. Bad news is, you've got an out-of-date estate plan, and we need to bring it up to date with the fact that your kids are now adults. In addition, your beneficiaries may have totally shifted in the time between your old estate plan and the present. My hourly rate is $300 per hour. However, for seminar attendees, I offer a 2-hour consult for $200, just a flat rate. If we need to do extra work after that, we'll talk about it. If we don't, then that's a 2-hour consult to bring you some peace of mind and a document review. And if nothing else, you'll understand what your documents do. A lot of times, either the previous attorney didn't fully explain them, or he or she did a great job of explaining them, but it's been 15 years and maybe you've forgotten a little bit about what they explained about the documents. And estate planning documents are among the most heavily legalese documents in the legal world. They have to be. That's just the way that the probate works, but they can be a little bit thick to wade through if you don't practice in this area. So I'm going to stop now and see if we have any questions. And if we do, be happy to answer them. Again, we're recording today, so please keep any questions kind of general in nature. And I'll stop screen sharing so we can all jump back into seeing each other.
I'm actually going to stop the recording at this point, and we'll move forward with questions from here. So
okay,
we go with that.